Joe Weisenthal, my white whale, who has never actually come to one of my events. Finally, Joe is here in the flesh, and we've got Christine Moy from Apollo, Matt Trudeau from ErisX, MC Later from Uniswap, and Tarun Chitra from Gauntlet. Welcome to the stage, everybody. We're going to talk about what went wrong, how to fix it. Take it away.
All right, well, thank you for the introduction. And how about, to kick it off, why don't we have each of you do a sort of very brief introduction, who you are and sort of what you do.
Sure. Hey, everybody. Super excited to be here. I'm Christine Moy. I just joined Apollo Global Management as a partner leading digital asset strategy. Apollo is a $500 billion alternative asset manager that is involved with public and private equities, fixed income and credit, insurance and retirement services, and helping to build out their digital assets business. So building and investing in Web3.
Good morning. Thanks, everybody, for making it to the first early panel of the conference. Matt Trudeau, I'm the Chief Operating Officer at ErisX. We operate a CFTC-regulated futures exchange and clearinghouse for cryptocurrency derivatives, as well as a spot market for cryptocurrencies.
I'm Mary Catherine, or MC Later. I'm the Chief Operating Officer of Uniswap Labs, which developed the Uniswap protocol, which is the largest decentralized exchange and automated market maker. Just out of curiosity, how many people have used Uniswap? OK, so an audience that's familiar. And we're based here in New York City.
Hey, I'm Tarun Chitra, founder of Gauntlet. We do risk monitoring and analysis of DeFi protocols, sort of $30–40 billion of assets that we kind of monitor and help kind of optimize both return and risk for.
All right, so obviously the panel topic is the CeFi blowups that we saw mostly this year, and we'll obviously get into that. You know, companies take in money, make bad decisions, can't pay it back, pretty bad stuff. Not also sort of classic, but I want to start out something a little different, and maybe Tarun, if you want to kick us off. Yesterday, the story of the Wintermute hack feels kind of novel. Like, it doesn't feel like there's an obvious TradFi analogy, so to speak.
Yeah, I mean, I think the way that this worked is there was this piece of software for making vanity addresses. So like, I can have 5 zeros in the front of my address, or I can have deadbeef as the first prefix. And it turned out that software had a critical vulnerability discovered last week by 2 independent researchers. And basically, Wintermute, I guess, didn't really pay attention to a lot of the security vulnerabilities, and a lot of their contracts actually were deployed using the vanity address. This is something where, you know, trading firms are not used to having to do, you know, critical cybersecurity OPSEC. And this is sort of one of these things that, like, I think in the normal TradFi world, you would just kind of either trust the exchange or sue someone or have some legal recourse.
Well, like, I'm curious, like, you know, coming from the TradFi perspective, there are certain risks that I think are probably intuitive in terms of, like, does this yield make sense? Can we pay back X? How do you think about, like, sort of like operational risk and pricing in operational risk? Because I guess anyone, whether in sort of CeFi, DeFi, or wherever, could be theoretically exposed to a hack and an irreversible transaction.
Yeah. I mean, like, I think, you know, at least from like a globally regulated financial institution perspective, you know, there have been well-worn paths and systems in place to understand what are the pieces within a given tech stack, like what are the pieces of software in a given tech stack. Like, you know, Tarun and I were talking about the Log4j vulnerability that was discovered last year. That was like a whole thing, like all enterprises, financial institutions across the board almost like dropped everything to like check their systems to see like where does this reside and how do we patch this up. And so, you know, I think for the crypto ecosystem, that hasn't yet evolved yet in terms of having that systematic tracking and drop everything and like fix it. I think that, you know, different companies have probably like varying levels of standards, but at least for, you know, a bank or a significant financial institution or a significant corporation, it's just table stakes to have to like have an active team maintain these things. And so, you know, that's the technological vulnerability. But what's really interesting about what we learned in this most recent unwind in the crypto ecosystem is that, it's actually a very small, small market with a short list of a number of very large participants that, are interacting with each other. And I think that's why what we saw in the past couple of months was so shocking, because the unwind of all of these, what we considered significant institutions, some that maybe we would have expected to have issues, but then some that we didn't expect to have issues, right? Kind of just caught up amongst each other. And so what's really fascinating about, kind of the recent events is that you can have a tech vulnerability that ends up having a contagion effect, because this could be a significant player that has, significant credit lines to other participants in the market. And as we said, it's a small market. Right. So if they're not able to repay any of their lines, either collateralized or uncollateralized, and there are a number of uncollateralized out there, then what is the trickle-down effect to others in the market? So super fascinating.
Yeah, and just another key obvious difference is that, unlike in TradFi and either DeFi or CeFi, these problems unfold in public, and they unfold on Twitter, right? And so that means that you also have a little bit of panic to go alongside them, and often misinformation. We had one example at Uniswap where something that was a phishing attack unrelated to the Uniswap protocol, but was another site pretending to be an interface and that then was draining people's wallets, was mischaracterized on Twitter as a hack of our smart contract. Uniswap protocols has not had any security vulnerabilities or been hacked. But then, we found out about that on Twitter, had to respond very rapidly and address it. And I think in those moments, you have to just have a culture of paranoia as a team. And many of these teams are very, very small. Or as Tarun said, they are primarily trading firms, they might not have a cybersecurity orientation. So I think it gets at a couple things. Some of what Christine mentioned, this intersection of obviously tech and financial risk. And that means that then you need people who are very attuned to what those intersections can cause. And the reality is, it's a pretty small pool of talent that really understands what those different categories of risks are and can react to them really quickly.
Anything on this?
Yeah, so if you look at Wintermute, you had a firm that's, I think, generally regarded as being fairly sophisticated and still suffered a hack. So, it's not working here, but okay. But I think it emphasizes the point that no matter how sophisticated the firm is, some external oversight can be beneficial. So a lot of shade gets thrown on regulation, but regulation brings oversight. You have, as a highly regulated exchange and clearinghouse, we don't just make promises and say, take our word for it. We have regulators that are crawling all over our technology, our operations, understanding who our staff are, what controls we have in place. So we have somebody else verifying the representations that we're making. And your question about how do you price that risk in, well, you can assume that there's less risk if somebody is verifying the things that people are saying that they're doing, and you don't just have to take their word for it.
Let's talk about take your word for it. And and Twitter in particular, and the reason I connect that is, earlier this year when 3AC blew up, I was like, oh my God, 3AC blew up. But then I thought, why am I surprised? I don't know anything about these guys. I just see they have a lot of followers on Twitter. And so I assumed they were smart, and I assumed they were savvy, but I don't know. How much is does the space need to work on reputation, and how much is it oh, this person must be smart because they have a lot of followers on Twitter and they have a lot of clout, actually still carry more significance than it should?
Well,
I'll throw that to anyone.
If we tie it back to traditional finance, Bernie Madoff had a pretty good reputation until he didn't.
True.
So, again, I'll make the point that the diligence that you would normally see in a traditional finance environment, where people have to present audited financials and other things, where there's someone else verifying it. Trust and reputation are extremely important. They're hard to build, easy to lose, but there's nothing that can really replace an independent verification.
So I feel like people always say this thing where crypto Twitter is the actual video game, and the coins are just this accounting for the video game. There's some truth to that, but I think at the end of the day, the best form of verification is on-chain success, right? If you can point to very publicly known addresses of yours and show some track record, that's sort of the thing I think that will be way more valuable in the future.
Can you just point to an address and say, look, there's a lot of coins in here, I'm smart?
So yeah, there's obviously this problem of hey, someone's public address says like 3ac.eth has 5 million coins, but then 3ac.junior.eth is like negative 4.9 million, right? Well, I mean, let's say it was on as sort of like a perp ERC20, but there's a sense in which people are creating identities that are traceable over time. And like, why do you think Chainalysis exists? Is because you can identify this. It's just that the finance side of crypto is never focused on this kind of tagging and tracking type of stuff. It's usually like the AML KYC side. But I suspect that the next cycle will have much more of this like on-chain track record type of thing. Important.
I mean, I think this is actually just comes down to what we in TradFi would call counterparty risk, right? And so, I think it being trackable on a blockchain is like, super cool, and kind of hope that it evolves there. But, as we have seen in the postmortem, 3AC was also involved in a lot of like CeFi arrangements as well. So, like post the unwind, I've been kind of thinking about like what is like a system-wide counterparty risk tracking system look like that like, has like the on-chain, activity, but then also like tracks the seed. Like it has to be like something that the industry comes together and builds for each other and for itself, because otherwise you're not going to get all of that information. But I mean, to wind it back a little bit also to what Matt said, I think that at the end of the day, it's about like the traditional underwriting process of like, let me see your audited financials, like let me review all the documents in detail. And I mean, to be fair, like in the bullish part of the market that we've seen in the past couple years, having anything like having any sort of TradFi or regulated or careful, cautious orientation was a little bit of disadvantage given how fast the market was moving and how fast it was growing. And a number of companies, have tried to be on the more conservative, quote unquote, TradFi side of the line, but they got blown away by a number of like the faster growing companies. So it's interesting that it's like a specific industry that isn't optimized or biased for this type of I guess traditional risk management approach. I mean, this may change post crises.
Yeah. I just want to clarify. Like I really want to push back on the need for independent oversight and traditional underwriting. I think that if we use these, especially in DeFi, if we have blockchain technologies and financial services that are transparent in a way that they never have been before, and we just apply the same traditional underwriting and the same traditional risk management, that is a huge loss of this opportunity and like really ignores a lot of the innovation. So what we're talking about depends entirely how you manage these kinds of risks, Joe, and whether someone's reputation matters when you're deciding to interact with them depends entirely on how and why you're interacting with them. Are you handing over your money in a centralized context, right? Are you trusting someone with your funds? Or are you interacting in a decentralized context, maybe with a non-custodial wallet, with a smart contract that you could audit independently, where you have other forms of verification? You don't need necessarily like a certain body or clearinghouses or other things. So I think that this is part of the complexity of where we are right now in crypto, is that we're conflating CeFi and DeFi. And I think if we regulate the decentralized technologies in the way that you might regulate centralized actors or those who are actually taking users' funds, that's a huge mistake.
And also just one more thing,
Please.
like, I think it's not well noted that the DeFi protocols held up the best in the most volatile part of the unwind. It was all the CeFi that fell apart, really.
Let me ask like what I think is sort of one of the core questions of the title of the panel itself. And like this business model, the ones that blew up, and we all know like who they are, like the Celsius, et cetera, like going out, getting a bunch of like a lot of retail money, but not just retail money, then lending it, and then like, is the model inherently flawed? Was there a way to make that work? Because they all sort of like incinerated. And it's a classic thing. It doesn't even seem like it almost doesn't even seem like a crypto story, because like taking in money and making bad bets is a story that's as old as finance. Like, was there a way to make this model work, or was it just like it has to be rethought from the ground up?
To me, nothing about the CeFi contagion is about crypto. It's like the same stories, the same problems, the same risks that exist in TradFi. And the story of the CeFi contagion, in my mind, is that DeFi thrived and that those services demonstrated how and where that level of whether it's transparency or composability can fight contagion.
I I don't think the CeFi business models work unless they're also an exchange. So like exchanges lending to their users, centralized exchanges lending to their users, sort of makes sense because they're much more liable for how the borrow gets used. But other than that, in general, if DeFi is the largest liquidity source, then you just never really need these kind of centralized lenders, right? The problem was that DeFi is still kind of hard to use for the people who would be able to provide liquidity. Like the CeFi lenders are easy for the technically unsophisticated, which is how they kind of preyed on them.
So I would say you should be suspicious of any CeFi firm that claims that it doesn't need to be regulated or the regulations don't apply. When you look at what the competitive advantage that some of these firms had was they just didn't have the cost of oversight or regulation or everything that goes into getting the licenses that other firms got. To your point about, there are some of us who spent a lot of time and energy and resources building up the robustness and the licenses that we needed. That gives those firms a competitive advantage in the near term, and that was maybe reflected in some of the yields that they were able to offer that traditional firms that were compliant were unable to offer. So near term, potentially a competitive advantage. Longer run, if something blows up, then there was a price to that competitive advantage. And there are some firms that didn't make it that spent the time trying to be compliant and suffered commercially.
Yeah.
Those of us who have made it through that
Can you
gauntlet.
talk a little bit more about the adverse selection effects if entities that make a point of like, we want to be totally on the right side of all the regulations, take 2 more years to launch than an entity that wanted to play a little faster and looser, what that does to like who's left and who has all the money and power and their like sort of like the sort of the risks that creates, if that's a thing.
I mean, look at the Binance volume market share right now. It is insane how much they've destroyed FTX and Coinbase. And FTX is not even, I would call them in the gray regulatory zone versus like Coinbase, right? I mean, it is actually insane. Like during the peak of the bull market, right? Like there were all these stories like FTX is going to kind of like be the dominant exchange. Yeah. And if you look at it now, it's like even Bybit is like, which is another sort of like I would put in the very gray regulatory exchange, is like kind of trouncing them volume-wise. So there's sort of this weird thing that, at least on the exchange side, I don't know how you get to at least like, even wash trading removed volumes that you see at the less regulated players. It's going to be extremely hard, unless it goes to DeFi trading mainly.
Anyone else have any thoughts on like this sort of question and like the effects of this sort of the way regulations are applied?
Well, I think your point, it is a good point in that even now, thinking about how you build new things, right? How do you make wallets safer? Do you anticipate the kinds of AML, KYC obligations that are very likely to happen at some point in the United States and build for that or not? And as you suggested, Joe, those companies that have tried to anticipate regulation and build for regulations have not succeeded. So it's not a positive signal. It doesn't suggest that you should build for that. I think if you look at other technology analogies, you're better off trying to solve a user problem. And so I think what's a better question to ask as a builder is not like what rules might happen and how should I comply with them, but what risks and problems might those rules try to address? And how can I keep my user safe? Ultimately, people don't want their wallets drained. And so if you can build applications on top of some of these technologies that help address some of those points of vulnerability, or you build a company that has a culture of security, that's better for your business, that's better for your product, that's better for the space overall, but you aren't necessarily sort of being hamstrung by guessing what regulators might be doing. So I guess and this is how we think about it at Uniswap, like you want less fraud, less security risk, a handful of different risks that you can try to think about as you're designing and building products. That's in users' interests, that's in the public interest. But it's not necessarily helpful to anticipate what rules might transpire when none of us really know.
So there might have been some adverse selection, but I think within the last few months, we're starting to see, from our standpoint, a shift where some of the messaging around the controls and regulation were not resonating with the market because they made things harder. It was more friction in the process, and people found it unpleasant. But now, a lot of firms that we would have talked to previously who maybe weren't as on board with that are calling and saying, we're getting questions from our customers, questions from our regulators. We have to vet our counterparties much more rigorously, and all the stuff that you're doing is actually really good, and it's an environment that we can trust and that our customers and our regulators can get comfortable with. So the adverse selection probably applied in the beginning.
Yeah.
Now I think it's starting to shift back.
So we're on the upswing where now the benefits of having survived this spring or summer are going to start paying off.
I also think. Go ahead.
Oh no, go ahead.
Actually, I also think we sort of crossed a chasm, so to speak, in mainstream adoption. And so now you don't have as much adverse selection in who's in the space necessarily,
Yeah.
right? And so you have a lot more people who know that they need to demonstrate their credibility in whether it's in managing technology risk or financial risk or their understanding of regulators, their ability to manage clients. So I think that overall there's a lot more reputational capital for the whole industry.
I think the other output of this is that the typical crypto consumer hopefully will be a little bit more scrutinizing than they were before, right? It was like, 20% APY to like 99% API. Like, where does this come from? Don't care, gonna get it. But I think that now there's probably like a rebalancing or like sort of an education process where it's like, oh, okay, like if it's like a high APY, there's likely associated risk and that's the price. Like, I think there's going to be like an evolution in how the typical crypto participant thinks about risk-adjusted pricing, which is, kind of what, and have like a more relative basis, even probably across like traditional markets as well.
So one of the things that I've been thinking about, every time a firm blows up, someone finds like an old screenshot from their website where it's like, here's our like cutting edge risk management and blah, blah, blah. Everyone has cutting edge risk management. And then
Until they don't.
Until they don't. And I like don't even like know what those words mean. And I'm curious like, what the companies even mean when they wrote that. And one of the things that I wonder, and maybe I'm totally off base, but I think about the industry, it's like pretty young, like just like age-wise. Like I suspect the people in this room are, if we were at some sort of, Goldman conference, there'd be a pretty big gap or something. And I'm curious if like part of the gap is essentially, or part of like what is a sort of a youthful attitude towards risk management that maybe is not, defined broadly, a youthful attitude towards risk management that is perhaps not sustainable or healthy.
I think there's also a lot of idiosyncratic risks that don't quite exist in normal finance.
Sure.
For instance, I think this Wintermute thing should be viewed as sort of like a negative towards them. Like they weren't actually monitoring CVEs. This was a very like publicly drawn out exploit. In fact, a bunch of attackers of other protocols had their funds drained because their vanity addresses were like vulnerable. So I think there's sort of this sense in which crypto, certainly people are more naive about risk, but also there's just a lot more moving parts that you have to manage. Versus in centralized land, it's, there's certainly, you can still have the same thing happen, right? Like the settlement person or your broker or clearinghouse can go down, but you can sue them. And like, because you can't sue them, you have to like take a much more like red team OPSEC approach to things rather than this kind of like cowboy approach. And I think crypto always has these cycles of going between cowboy approach to like going back to like a more technologically focused approach.
Some of the best security researchers, and I'm thinking of two people in particular in the space, are under the age of like 22. And so I don't think that there's a correlation between youth and the ability to manage risk in crypto. But if part of what you're getting at, Joe, is like there is a sense of invulnerability, perhaps among some younger entrepreneurs who haven't been humbled by how painful it is if your firm fails and you lose people's money. Like certainly, as with any industry, we have characters who demonstrate that. But I think that the kind of unique paranoia you have to address some of the idiosyncratic risks that Tarun's mentioning are about skill set, and a lot of that is a technical skill set that is most common in people who are pretty young.
Look, so to your question, I started in the capital markets industry in 2000 when electronic trading, direct market access was a brand new thing. And back then we were very excited about it. We didn't think you needed people in the process anymore. And our views were very much about technology, and we're going to revolutionize everything, and it's all going to change. And now, 20 plus years later, I've started to understand that there was some wisdom that I could have received from some of the people that were more experienced in the market at that time. And it's a learning process. The tech and the ways that we did things back then 20 years ago would never fly today. So the way that things are done today in the crypto markets are going to change through time as they become more mature. But I would say what feels like admonishment may actually be wisdom depending on the source.
Yeah, and also, like, CeFi centralized companies do have vulnerabilities.
Right.
They're just not on the public blockchain for everyone to see.
Right.
So that's the other thing. Like, I mean, this is why if you look at the largest companies and the largest financial institutions, they have a massive war chest and armies of people focused on cyber, not because they woke up one day and said, like, I think cyber is important, but because they actually did suffer some vulnerabilities over time. They get fixed, they get smoothed over, like, and then they evolve from there, and then they realize, like, oh man, this is like a really big thing, like, need to like make sure we're on it. So I think, you have an industry where everyone is starting to build at the same time. So you have everyone at the starting line and like just a little bit beyond. And so from a level of experience and there's like track record, like that's just all building together. And then the second thing, it's like all on a transparent ledger. So it's like if something's happening to someone, like we're all watching it. Where, I would say in TradFi, everyone started at different times, so everyone's at different levels of maturity. Like, they don't have to, like, really publicly disclose it unless it's impacting, like, customers' accounts. And then, so I think that's kind of, like, the main thing.
I want to go back to something you said at almost the beginning of the conversation. It's like, what is the point of all this if the answer is just recreating all the same auditing and disclosure requirements and whatever that the TradFi, what exactly has been accomplished? Like, that makes a lot of sense, but what does the new thing look like? What does the equivalent of good, like due diligence, like seeing, like figuring out whether you're taking good counterparty risk look like in a sort of, I don't know, a new world?
Yeah. Well, a couple thoughts. I think for one, I mean, you think about very, very simply like disclosure for smart contracts, right? So one, you can see the technology that your either intermediary, if they're not an intermediary, or counterparty has. You can see that and audit that. So maybe being able to publish third-party audit reports for the technology, for example, would be one. For tokens, like information about tokens is available on the public blockchain. And so you could, instead of having to have a quarterly disclosure process where people get to doctor their numbers, you could instead say these 3 metrics must be public all the time. And the SEC could propose like an instant Edgar, where you see those for all those sort of tokens that they believe may potentially be securities. So there's lots of different things you could do because you have all this transparent public information. So I think it's an opportunity to think about all of that. And also that we are still approaching, or rather we're still looking at all this from the lens of capital markets. And there's a lot of things that are on top of some of these that interact with smart contracts like Uniswap, that are on blockchains, that are tokens, that really aren't necessarily about capital formation or capital markets. And so we also, I think, are at risk of looping in some things that may have more community attributes or commerce attributes than they have sort of capital markets attributes, as we're now trying to figure out how to address some of the risks that we've experienced in the past 6 months.
I mean, the other thing I'd add is, if you think about a loan you take at BlockFi or Celsius, or took, I guess, you had no clue, A, how the interest rate was computed, B, what margin they actually were holding, C, like kind of any disclosure of like what their entire sort of capital base was. And I think even in normal banks, that's not really true, right? You don't like actually get that much disclosure about like every single holding or like what swaps they cleared today. You get this kind of like T plus 1 week disclosure realistically if you wanted to get the entire balance sheet. The idea that that is just real time is much better for at least monitoring this type of stuff. And you can have many people monitoring it, right? It's not just like there's like one person who's the hired auditor to like check with ISDA if like this thing settled correctly, right? No one has to do that anymore. And that's the future of that, right?
What does it say though? I mean, like the catalyst event that kicked everything off was the Luna collapse, which was all on chain. Everyone could see how it worked. Like, right? It was not the code was available. Everyone could see all the wallets. It had this like eye-popping yield, which should have like been this big red flag. But you had some pretty serious players in the industry vouch for it, and they're like, oh no, this is legit. And I'm like, So it's like, what are the prospects for this realistically being a useful sort of like disclosure information regime? If here's something that like, that checked all the boxes, and yet sophisticated people like lost a ton of money on it.
Well, I wouldn't say that it checked all the boxes. A couple things. One is, not everyone who bought Luna may have understood those risks or known those risks. So one thing that we're actually working on at Uniswap for our web app is token labels and token warnings. So like red, yellow, green, like what's the level of risk? And in the demos, Luna was our example, actually, of like a high-risk token that would be easily flagged. There's a bunch of standard metrics, whether it's like the distribution of the ownership of the token, the level, how liquid it is, how long it's been launched, a bunch of different things you can look at to kind of approximate risk. So there's a little bit of maybe some of that truth in advertising that could be improved that would allow people who maybe didn't know what boxes to check. Having said that, though, to some extent, people choose the risk they take. Those sophisticated buyers, they arguably did know those risks that they were taking and lost that money. And so then I think that becomes a question of like, should that be allowed to be a financial product at all? There are plenty of high-risk instruments that are available in TradFi, right?
Sure.
And so that I think that kind of gets at what has access to capital, what do you allow access to access capital markets. But we can still, I think, improve broad consumer understanding of some of those risks.
It seems to me like this notion that because everything's on chain, there isn't going to be oversight and audit is a bit of it's wrong-headed, because you still, as we've seen, a lot of people aren't actually inspecting the smart contract. They're not even necessarily questioning the economics of a model like the Terra Luna. So someone is still inspecting that smart contract, someone is still auditing it, someone is still making a representation that people are relying on. It's just a different kind of representation. So it might change, but there's still a role for independent oversight and audit in terms of pressure testing and looking for vulnerabilities and identifying those risks so that everything becomes more secure and more robust.
I think the only thing I'd add to that is that the current normal finance world involves a very small number of auditors, right? Like in the long run, the interesting thing about crypto is like there's many possible people who come. There were many people who were pretty loud about Luna being, effectively Ponzi scheme, and it was, in normal traditional finance, if there was an equivalent Ponzi scheme like Madoff, it actually lasts a lot longer because it's like there's not actually this like many people looking at the same data thing. And so that the idea of like the many people versus one or two is like one of the main advantages.
Well, we just have a couple of minutes left, but I tweet all the time, so on my mind is like another Twitter question. But it did feel like to me, to this point that you made, it's like lots of people were looking at Luna and saying, this is really bad, this kind of looks like, this is unsustainable. But I also think it also looks like there is a culture where like critics do get shut down pretty quickly, or they're accused of like FUD, or like trying to like instigate a run at a competitive entity. Like, is that changing? Does that need to change, or is that just like it's always going to be how it is?
This was true with equities, right? Also, like I feel like the fact that social media and finance have not found a stable equilibrium is just a problem for all of finance.
Right.
Like regardless.
What about in terms of like from your culture of criticism, or like do you perceive that it's like there's any work that needs to be done on that?
I think it's just like the intersection between mass social media and investments. As Tarun said, it's related to meme stocks, and it's also related to crypto. I just think that as I said before, moving forward, I think the typical crypto investor is going to be a little bit more grounded in, okay, like now I need to better understand what are the underlying risks of what I'm investing in. I think everyone is a big boy and big girl around here. They should know like what the risks are that are involved, but that they should still be able to participate in it, like eyes wide open.
Sure.
I mean, in some ways, like some of what we're talking about, like it's like if you want the easy answers are, okay, well maybe you have a tier of investors that really know versus the investors that don't know, and that's actually what we in TradFi called like, accreditation of like, accredited investor or QP or whatever, but we know a lot of that is not fair and, it has restricted a lot of access to really promising financial investments for a broad swath of people, right? So, I don't think DeFi, crypto should go there. I just think that a lot more has to be invested in educating your typical crypto investor. And then additionally, I think coming out of like the Terra Luna experience, there were a few vocal critics of it. There were probably a lot of people in the middle who were like, I don't get this, but like everyone who's super smart seems to be really into this, so maybe I just don't get this. And I think that like
That's literally the whole thing, all of us here, right?
yeah, and so I think like, you know, now people might feel more firmer in their self-conviction of like, okay, when I said I didn't get it, I actually didn't get it, but that actually means I didn't get it because there's nothing to get here. Like, I think people will have more self-assurance post this experience. So that's my take.
Well, we're out of time. We could have probably talked for like 3 more hours because I feel like there were just so many different threads to pull. But thank you so much for the conversation. And thank you.
Thank you.
Thanks.